picture the modern battlefield for a second. Like, if you ask the average retail investor to visualize where all these global defense budgets are flowing, the mental image is almost uniformly, heavy metal.
Oh, absolutely. Tanks, planes, ships.
Right. We picture massive, multi-ton main battle tanks churning up the earth, or fifth-generation fighter jets tearing through the sound barrier, aircraft carriers projecting power. It's an industrial era view of warfare, right? Defined by loud, explosive, highly visible, kinetic power.
It is, but that industrial bias is actually a huge vulnerability for anyone trying to analyze the defense sector right now. The visceral expectation of heavy armor has just been entirely subverted by the reality of contemporary conflict.
You're talking about the shift away from those good platforms.
Exactly. When we analyze the data streaming out of modern theaters of operation, the apex predators are no longer these multi-million-dollar metal behemoths. The battlefield has undergone a fundamental phase shift.
Yeah, it's a completely different ballgame.
Right, so we are now analyzing environments dominated by silent, invisible, 100-kilowatt directed energy weapons. We're looking at autonomous swarms of loitering munitions devices that, cost less than a used sedan, systematically dismantling legacy defense infrastructure. We're even factoring in the capability to blind low Earth orbit satellites from the ground.
The technology sounds basically indistinguishable from science fiction at this point.
It really does.
But the material we are dissecting for you today isn't some speculative white paper from a military think tank. It is a highly scrutinized corporate earnings call. We're watching the real-time, highly lucrative commercialization of lethal science fiction.
And that's what makes it so fascinating from an investment standpoint.
Exactly. So our mission for you today on this Talk Tickers Deep Dive is to slice through the dense, highly insulated jargon of the defense industry. We want to reverse engineer what management is attempting to frame as a quote-unquote financial transition year and really provide you with actionable intelligence.
We need to see what's actually under the hood.
Right, so we are pointing our analytical lens directly at Electro Optic Systems trading as EOS following the release of their 2025 financial results. Because we need to determine if this stock is the future of defense architecture or just, a speculative trap for your portfolio.
And to make that determination, we really have to start by auditing the raw financial data management just reported. Because honestly, on the surface, the numbers present a pretty jarring contradiction.
They really do.
Yeah. If you look at the top line, revenue for 2025 printed at 128.5 million Australian dollars.
Which represents a contraction from their 2024 figures. And that contraction is what I want to challenge you on immediately.
Sure.
Because we are sitting in the middle of a massive, undeniably huge global defense spending boom, right?
No.
Every geopolitical analyst, every macroeconomic model is tracking historic escalations in defense budgets across NATO, across the Asia-Pacific and the Middle East.
Oh, absolutely. The macro environment is incredibly bullish for defense.
So explain to me how a defense contractor operating in arguably the most target-rich procurement environment in a generation manages to report lower year-over-year revenues. It doesn't make sense on the surface.
It is a totally counterintuitive signal, I agree. And it requires us to really understand the mechanics of defense accounting. The defense contracting world does not operate on a smooth, predictable, monthly recurring revenue model like, say, a consumer software company.
Right, it's not a subscription business.
Exactly. Revenues in this sector are notoriously lumpy. You are dealing with multi-year procurement cycles, government bureaucratic delays, and very strict revenue recognition rules. So the contraction we see in EOS's 2025 revenue is a result of a literal gap in their calendar, what analysts refer to as a transition year.
Well, a transition year can sometimes just be management cover for losing market share,
That's a fair point. It definitely can be.
So walk me through the actual mechanics of this specific gap. Like, what caused the revenue spigot to temporarily tighten for EOS?
There are three distinct catalysts driving this gap, really. The first is just the natural life cycle of legacy contracts. EOS had several massive historical contracts, most notably a highly lucrative, long-running arrangement in the Middle East that finally reached completion and rolled off the books in 2025.
Okay, so the cash flow from those legacy installations simply dried up.
Right.
But if they're acquiring new contracts, which they are, shouldn't the new money just immediately replace the old money?
In theory, yes.
Mm-hmm.
But the reality of manufacturing complex military hardware introduces a lag. That's the second catalyst. EOS has signed a staggering volume of new contracts, which we will analyze shortly.
Yeah, the backlog numbers are wild.
They are. However, the accounting rules, specifically how revenue is recognized upon delivery rather than upon signature, mean that while they are actively procuring materials, running their engineering teams at maximum capacity, and building the technology right now, the actual cash does not hit the income statement's revenue line until the physical hardware is delivered.
Delivered and accepted by the client.
Exactly. The new money hasn't started flowing yet because the products are literally still on the factory floor.
So we basically have a temporal mismatch here. The old contracts expired and the new hardware isn't out the door yet. That accounts for the top line revenue dip. But there is a third factor you mentioned, which ties into the underlying EBITDA figure. And I gotta say, that number is ugly.
It is highly unattractive at first glance, for sure. EOS reported an underlying EBITDA earnings before interest, taxes, depreciation, and amortization of a negative $24 million. They operated at a substantial loss.
Which brings us back to the carrying costs of that transition year. Like, if your top-line revenue contracts because of this delivery lag, your fixed overhead doesn't magically shrink with it.
Right. You can't just fire everyone and rehire them a year later.
Exactly. You still have to pay the advanced propulsion engineers, the laser physicists, the facility leases, the compliance officers. All of that still costs money.
Precisely. And the CFO explicitly stated on the earnings call that the company's operational break-even point sits at roughly $200 million in annual revenue. So because they only recognize $128.5 million in 2025, they fell drastically short of their required operational leverage. They basically had to absorb the fixed costs of a much larger, growth-oriented company on the revenue of a contracting one, which dragged the EBITDA deep into the red.
That makes total sense. However, this is where the financial bifurcation really occurs, I think. Because if you move past the income statement and look at their margins and their balance sheet, the narrative flips entirely.
Oh, it's night and day.
Let's focus on the gross margin first, because that number honestly caught my attention. Despite the revenue drop and the EBITDA loss, their gross margin skyrocketed to 63%.
Yeah, it's massive.
In the hardware manufacturing space, where you are dealing with physical supply chains and raw materials, a 63% margin is practically unheard of.
It really is. It's essentially a software-like margin applied to heavy industrial output. And it tells us something vital about their pricing power and their technological moat.
Meaning they aren't getting squeezed by their buyers?
Not at all. The legacy products they finished delivering and the new products they are currently engineering command an immense premium in the market. They are not competing on price, they are competing on proprietary capability. Governments are willing to pay massive markups for systems that actually work against modern threats.
Right. A 63% gross margin indicates they aren't just a commodity supplier. Like, they have a localized monopoly on a very specific capability, and that pricing power feeds directly into the balance sheet, which, unlike the income statement, looks virtually bulletproof.
The balance sheet is a fortress right now. EOS ended 2025 with $107 million in cash reserves and absolutely zero debt.
Zero debt. That's huge.
They are paying no interest, they have no looming debt covenants, and they have the liquid capital to easily weather this transition gap.
But wait, if they are burning cash to the tune of a $24 million EBITDA loss, where did a $107 million war chest even come from? Like, it clearly didn't come from their core operations last year.
Right, it didn't. It came from the third catalyst of their transition year, a highly strategic divestiture. At the beginning of 2025, EOS sold off a subsidiary called EM Solutions.
Okay.
This was a non-core part of their business focused on satellite communications terminals. By shedding that asset, they forfeited the future revenue EM Solutions would have generated, which, by the way, further explains the 2025 top-line contraction. But they booked a massive $91 million upfront gain on the sale.
So they essentially traded a steady non-core revenue stream
for an immediate massive cash injection.
Right. They recapitalized their own balance sheet to ensure they survived the gap year between those Middle East contracts ending and the new defense boom contracts beginning.
Exactly. It was an aggressive but totally necessary maneuver to de-risk the company. So when you look at the headline numbers in context, you see a company that practically orchestrated its own top-line shrinkage to build a $107 million cash moat, protecting itself while it engineers the next generation of highly profitable 63% margin hardware.
Which means any investor trying to value the stock based solely on a multiple of its 2025 earnings is making a fundamental analytical error.
They're looking at the wrong metrics entirely.
They are staring at the rearview mirror while the vehicle is accelerating. To understand the actual trajectory of EOS, we have to look at the headlights. We need to transition away from the recognized revenue and dig into the order book, because the backlog explosion they just reported fundamentally alters the scale of this company.
It really does. The order book is the true barometer of demand in the defense sector. Right. And the contrast between their historical baseline and their current reality is just staggering. Let's look at the data.
Lay it out for us.
In the entirety of 2024, EOS secured a total of 6 new orders. The aggregate value of those orders was $70 million.
Okay, $70 million. That is a steady, if somewhat unremarkable, pace for a mid-cap defense contractor.
Exactly. It's fine, but nothing to write home about. But the 2025 figures represent a violent paradigm shift. In 2025, the order intake accelerated to 18 distinct contracts.
Wow.
And the total value surged to $420 million. Consequently, their unconditional order book, which means these are firm, legally binding, guaranteed contracts, not just, letters of intent, now sits at an all-time record high of $459 million.
A 600% year-over-year increase in order intake. I mean, that is not organic incremental growth. That is a step function change in market penetration.
Absolutely.
A company does not suddenly book 6 times its historical average unless the broader macro environment violently aligns with its specific product catalog.
And that alignment is exactly what is happening right now. Sure. To understand why global defense ministries are suddenly writing $500 checks to EOS, we have to look at the tactical evolution of the modern battlefield.
The drone problem.
Right. The data emerging from ongoing global conflicts, and obviously we are analyzing this purely from a mechanical, non-political perspective, demonstrates that the fundamental economics of warfare have been broken by the proliferation of drones.
Yeah, the CEO articulated this shift explicitly on the earnings call. He noted that the dominant paradigm has moved away from traditional artillery duels toward an environment saturated with loitering ammunition.
That's the industry term, yeah.
We really need to explore the mechanics of why this is so terrifying for traditional military forces.
It all comes down to the cost-exchange ratio. Historically, defeating an enemy asset required an asset of roughly equal or greater value. Tank versus tank, fighter jet versus fighter jet. Today, a non-state actor or a conventional military can deploy a loitering drone, which is essentially a flying bomb built with commercial off-the-shelf parts, for a few $1,000s. That drone can navigate to a set of coordinates, circle an area waiting for a target of opportunity, and then execute a terminal dive onto a main battle tank or a radar installation that costs $20, $30, or $50 million.
And the traditional defense against airborne threats is an anti-air missile, like a Patriot missile. But a single Patriot interceptor costs around $4 million, right?
Roughly, yes. Sometimes more, depending on the variant.
You cannot mathematically sustain a defense strategy where you are firing a $4 million missile to shoot down a $20,000 drone. You will exhaust your treasury before the enemy exhausts their drone supply.
The asymmetric economics are totally unsustainable, and this has triggered a global scramble among defense procurement agencies. Every military on Earth is searching for a cost-effective counter-unmanned aerial system, or CUAS.
And for years, the preferred methodology was what the industry calls soft kill, right?
Correct.
Let's define the parameters of a soft kill, because understanding its limitations is critical to understanding EOS's massive backlog. How does a soft kill system actually operate?
Soft kill is essentially electronic warfare. It is the tactical deployment of the electromagnetic spectrum to sever the communication link between a drone and its operator. Imagine a consumer drone controlled by a pilot via a radio frequency remote.
Like a joystick setup.
Exactly. A soft kill system floods that specific frequency band with overwhelming radio noise. The drone's receiver is blinded by the interference, the command link drops, and the drone typically enters a fail-safe mode where it either hovers until its battery dies or attempts to return to its origin point.
It is an elegant solution. It is non-kinetic, meaning you aren't firing explosive shells into the air, which is highly preferable in urban environments or, around critical infrastructure like airports. You basically just yell louder on the radio spectrum than the pilot.
That's a great way to put it.
But the earning call made it abundantly clear that soft kill is rapidly losing its efficacy. Why is electronic warfare suddenly failing against modern drones?
Well, the drone manufacturers have adapted, implementing what is known as hardening. They are equipping these cheap platforms with frequency hopping radios, heavy encryption, and really robust anti-jamming hardware. But the true death knell for soft kill is the integration of artificial intelligence and machine vision.
This is the turning point. Because if a drone relies on a live feed to a human pilot, jamming the signal stops the attack. But if you put an AI neural network on board the drone itself,
the need for a pilot vanishes entirely. Modern loitering munitions are programmed with optical recognition software before they even launch. They fly to a designated grid square using inertial navigation, which, crucially, cannot be jammed, and then the onboard camera scans the terrain.
just looking for a shape.
Exactly. The AI is trained to recognize the thermal and optical signature of a tank, a command tent, or an artillery piece. Once the onboard computer identifies the target, it initiates the attack autonomously.
So if you point a soft-kill electronic warfare jammer at a fully autonomous drone, flooding the radio spectrum with noise, the drone essentially just ignores you. It isn't listening for a signal anyway. It is relying entirely on its own internal brain and camera.
Exactly right. When you sever the communication link of an autonomous weapon, you haven't stopped it. You've just ensured that no one can recall it. So when soft kill fails, you have only one remaining option, a hard kill. You must physically dismantle the aerodynamic integrity of the drone while it is in flight.
And hard kill kinetic effectors are the absolute core of EOS's business model. They build remote weapon stations that are mathematically precise enough to track a piece of plastic moving at 200 miles an hour and hit it with a kinetic projectile.
Which is incredibly hard to do.
But shooting bullets into the air is expensive and dangerous. The real breakthrough, the technological moat that is driving this $420 million order intake, is their transition from kinetic bullets to high-energy photons.
The commercialization of directed energy weapons. Yes. This is where EOS separates itself from the broader defense market. Let's analyze the first of the two massive structural wins they detailed on the call. The Dutch deal.
Yeah, this isn't just a win for EOS, it is a historical milestone for the global defense industry. EOS secured the world's first export contract for a 100 kilowatt high-energy laser weapon.
The very first.
The Netherlands government executed a contract worth 71 million euros to acquire these systems.
And the magnitude of a 100 kilowatt laser export really cannot be overstated. To grasp its significance, we must contextualize it against the failures of the broader European defense apparatus. Management highlighted the agonizingly slow progress of Germany's domestic directed energy programs on the call.
The contrast is brutal. The German government, recognizing the threat of drone swarms, has been heavily subsidizing laser research with massive domestic defense conglomerates, companies like Rheinmetall and MBDA. They have pumped over 150 million euros of taxpayer capital into this research over the course of 15 years.
15 years. And the output of that 15-year, 150 million euro investment is a functional 20 kilowatt laser.
It's a 20 kilowatt system. Let's break down the physics of why the wattage matters so much on the battlefield. Like, why is a 20 kilowatt laser insufficient against modern threats?
It comes down to dwell time and thermal mechanics. A laser destroys a drone by superheating its components, melting the plastic airframe, detonating the lithium-ion battery, or frying the optical sensors. But lasers are subject to atmospheric interference. Dust, humidity, and thermal blooming all scatter the photons and diffuse the beam's energy.
So the beam loses power the further it travels through the air.
Correct. A 20 kilowatt laser simply doesn't project enough raw thermal energy to quickly run through a target at a militarily useful range. It requires a long dwell time, meaning the laser must stay locked on the exact same square inch of a highly maneuverable, fast-moving drone for several seconds to transfer enough heat to destroy it.
Which is tough when the target is dodging.
Exactly. And if a swarm of 30 drones is approaching, a 20 kilowatt laser taking 5 seconds per drone will quickly be overwhelmed.
But a 100 kilowatt laser changes the physics of the engagement entirely.
At 100 kilowatts, you are delivering catastrophic thermal energy almost instantaneously. The dwell time drops from seconds to fractions of a second. You can rapidly sequentially engage a massive swarm, burning them out of the sky one after another, and you could do it at a much greater operational range, giving your base more time to react.
So the German defense giants, after 15 years, have a 20 kilowatt system that requires too much dwell time. And their proposal to the German government was to request another 500 million euros and 5 more years of development to hopefully reach 50 kilowatts.
And that is the exact moment EOS disrupted the entire European procurement strategy. They arrived and presented a functional, tested, ready-to-export 100 kilowatt laser. And management stated they can even scale the existing architecture up to 150 kilowatts. They offered to deliver a system with 5 times the power of the domestic German alternative in half the time for less than half the price.
That value proposition is so overwhelming that the German parliament literally halted their domestic sole source laser procurement program just to evaluate the EOS system. I mean, that is an almost unprecedented event in defense contracting, where domestic protectionism usually rules.
It speaks to the absolute necessity of the capability. The drone threat in Eastern Europe is so severe right now that NATO countries can no longer afford to subsidize failing domestic science projects. They need immediate operational lethality. And crucially, EOS possesses a profound structural advantage. They own the entirety of the intellectual property for their laser architecture.
Okay, why does owning the IP end-to-end matter so much in these international export deals?
Because defense deals are highly political. When the Netherlands or Germany buys a weapon system, they usually demand offset agreements or localized manufacturing to create domestic jobs and secure their own supply chains.
They want the factory in their own backyard.
Right. If EOS had to rely on third-party licenses for the laser's power generation or the optical focusing lenses, setting up a factory in Europe would be a bureaucratic nightmare of export controls and licensing fees.
So multiple governments would have to sign off on the tech transfer.
Exactly. But because EOS owns the IP, they can offer a turnkey solution. If the German government says, we will buy your 100 kilowatt laser, but it must be built in Bavaria, EOS can simply agree, set up a localized supply chain, and execute the contract without asking permission from secondary technology vendors.
That agility is a massive competitive moat.
It allows them to corner the market on high-energy directed exports, while their competitors are still asking for research grants. Now, the laser represents their dominance in the heavy, static defense market. But the second major win detailed on the call represents their dominance in mobile armored warfare. And it centers on one of the most iconic military platforms on Earth, the M1 Abrams main battle tank.
Yes, this represents their re-entry into the United States Army procurement ecosystem, which is universally acknowledged as the holy grail for any international defense contractor. EOS was selected as the sole integration partner to mount their R400 remote weapon station onto the brand new prototype of the US M1A3 Abrams.
And to appreciate the scale of this opportunity, we have to look at the vulnerability of modern armor. We discussed how loitering munitions attack tanks earlier. Main battle tanks have incredibly thick frontal armor designed to withstand other tanks.
Right, taking a shell to the front.
With their top armor, the roof of the turret is relatively thin.
And drones attack from above. They drop shaped charges directly onto the weakest point of a multi-million-dollar vehicle.
Exactly. So the U.S. Army and General Dynamics, which manufactures the Abrams, recognize that the next generation of the tank, the M1A3, must have an integrated hard-kill defense mechanism against overhead drones.
It's non-negotiable now.
Right. And they selected the EOS R400 system to serve as that localized air defense shield for the tank itself.
Now, management was highly disciplined in their forward guidance here. They explicitly cautioned that the initial dollar value of this specific prototype integration contract is relatively small. It is just a testing and evaluation phase. I want to push you on that. If it's just a prototype, why is the market treating this as a massive structural win?
Because of the multiplicative scale of U.S. defense procurement, the U.S. Army operates thousands of Abrams tanks. Furthermore, allied nations across the globe, from Australia to Poland to Taiwan, operate export variants of the Abrams.
So the market is huge.
If the EOS R400 successfully passes these prototype trials and is designated as the standard factory inclusion for all new M1A3s, or even the standard retrofit upgrade kit for legacy models, the volume is astronomical.
And management actually quantified that volume. They estimate the total addressable market potential just for this specific Abrams integration adds up to $3 billion over the next 15 years.
Yeah, that's a lot of zeros.
$3 billion of potential baseline revenue stemming from a single vehicle platform. And right now, EOS is sitting in the pole position as the sole integration partner.
It alters the entire risk profile of the company. It provides a level of baseline revenue visibility that allows them to aggressively scale their operations with confidence. But, whether we are discussing the 100 kilowatt lasers defending a Dutch airbase or the R400 remote weapon stations defending a U.S. Army tank, there is a missing piece of the puzzle here.
Which is, how do these weapons actually acquire their targets?
Exactly.
This is the crux of the engineering challenge. A drone is a piece of plastic or carbon fiber, maybe the size of a lawnmower, flying close to the ground, trying to hide in the radar clutter of trees and buildings. Traditional radar struggles immensely with targets that's small and slow. So, how does EOS ensure their laser is pointing at the right pixel in the sky?
That operational challenge brings us to the most strategic capital allocation decision management made in 2025. We discussed earlier how they generated a $91 million cash pile by selling off their satellite communications division.
Right.
Well, they immediately deployed $36 million of that cash to acquire a company called Mars.
They bought an artificial intelligence firm. The jargon used on the call was that Mars provides C2, or command and control systems. Let's translate that out of defense speak. What does Mars actually do for the EOS product suite?
Think of an air defense network as an organic body. The radar arrays and optical cameras are the eyes. The EOS 100 kilowatt laser, or the R400 cannon, is the muscle, the effector that delivers the punch. Mars is the central nervous system in the brain.
So without Mars, EOS just sells a really powerful, really accurate, but ultimately blind muscle. They rely on the client to figure out how to aim it.
Exactly. And aiming a CUAS system is incredibly complex. A radar system might detect a radar cross-section in the sky, but is it a hostile loitering munition? Is it a commercial airliner? Is it a flock of geese? Is it a cloud formation?
The clutter problem.
Yes. The artificial intelligence algorithms developed by Mars specialize in sensor fusion. The software takes the raw, messy data feeds from radar, acoustic sensors, and thermal optics and instantaneously filters out the environmental noise.
Okay, so it sees through the mess.
Right. The AI uses computer vision to definitively classify a target as a hostile drone, calculates its trajectory, predicts its future location, and then automatically commands the EOS weapon system to orient itself, track the target, and engage.
It removes the cognitive load from the human operator. The AI watches the sky, identifies the threat, and aims the laser. The operator simply has to authorize the trigger pull.
And by acquiring Mars, EOS executed a profound transition in their corporate identity. They moved from being a component vendor to a prime contractor. Governments and major commercial clients like international airports or nuclear power facilities do not want the integration risk of buying a radar from one company, a laser from a second company, and the AI targeting software from a third company, and then spending years trying to force proprietary code to communicate.
They want a unified turnkey solution.
Exactly.
By bringing Mars in-house, EOS can now walk into a procurement office and say, we will sell you the entire anti-drone shield, our AI, talking to our optics, aiming our laser. It makes the purchasing decision infinitely simpler for the buyer.
It also allows EOS to capture a significantly larger percentage of the total contract value.
Right.
The Mars acquisition is the connective tissue that makes their massive backlog executable.
Okay, we have established a really robust narrative here. We have a company sitting on a massive, highly profitable 63% margin product. They have a dominant technological moat with a 100 kilowatt laser. They have deep integration into the world's premier tank platform, and they have acquired the AI architecture to make it all work autonomously.
A very strong and.
The structural foundation is impeccable. But we need to tie this back to the raw financials for our listeners. How and when does this $459 million unconditional backlog translate into actual profitability?
Because eventually the narrative has to generate cash flow, right?
Exactly. Show me the money.
Management provided highly specific forward guidance regarding the timeline of this revenue realization. They project that they will execute and deliver between 40 and 50% of their current unconditional order book over the next fiscal year in 2026.
Let's run the mathematics on that projection because it points to an immediate inflection point. If you calculate 40 to 50% of a $459 million backlog, you are looking at a guaranteed revenue window for 2026 of roughly $180 million to $230 million.
Which brings us back to the most critical data point from the beginning of our analysis.
The break-even number.
Yes. The CFO clearly stated that the company's operational break-even point, the threshold where the fixed costs are covered and the business begins generating positive EBITDA, is $200 million in revenue.
And their conservative, locked-in delivery schedule for next year places them directly straddling that $200 million threshold. If they execute flawlessly and hit the upper bound of that 50% realization, they will print $230 million in revenue. They cross the profitability Rubicon.
The transition year ends and the growth phase begins. And we must emphasize that this 180 to 230 million projection is derived solely from the contracts they have already signed as of today.
Right, it's just the backlog.
It represents them simply clearing out the existing manufacturing queue. It assigns zero value to any new orders they might secure and deliver within the 2026 calendar year.
So any new short cycle deals signed in Q1 or Q2 of next year are pure upside to that projection. Furthermore, management provided guidance on their margin outlook. While they acknowledge that the astronomical 63% gross margin achieved in 2025 will likely cool off slightly, primarily because it was somewhat inflated by the highly lucrative final payments of that legacy Middle Eastern contract, they confidently projected that gross margins will remain structurally elevated, sitting comfortably above their historical 50% baseline.
Generating north of $200 million in revenue while maintaining gross margins in excess of 50% creates massive operational leverage. The amount of free cash flow that will drop to the bottom line under those conditions will fundamentally re-rate the valuation of the stock.
It changes the whole math.
But the earnings call also dedicated time to what we can classify as the blue sky pipeline.
Oh, right. These are the transformational mega cap deals that aren't sitting in the guaranteed backlog yet, but are actively moving through the procurement channels. The deals that could, frankly, redefine the company's entire market capitalization.
The most consequential of these opportunities is the German UTF tender.
Let's break down the scale of the UTF program. The German armed forces are executing a massive modernization initiative, and they have issued a tender to procure over 3,000 remote weapon stations to mount on their armored vehicle fleet. Management's internal estimates place the total potential value of this single contract at over 1 billion euros.
Over 1 billion euros for a single procurement vehicle. To compete for this, EOS has formed a strategic partnership with a highly respected domestic German defense firm named Diehl. The tender process began with 13 major defense conglomerates bidding for the contract. Through rigorous technical evaluations and live-fire down selections, the German military has eliminated 10 of those competitors.
EOS and Diehl have survived the culling. They are now down to the final 3 bidders.
And we must connect this back to our earlier analysis of the laser market. EOS already possesses immense momentum and high-level visibility within the German procurement apparatus. The German parliament already knows who EOS is. They halted their own domestic laser program because EOS's technology was so vastly superior.
It's true they already have a foot in the door.
That pre-existing relationship and demonstrated technological superiority provide a massive intangible advantage in this UTF tender.
Now, management was clear that the final decision and contract award for the UTF program is not expected until 2027. So this is not a short-term catalyst. It won't impact the 2026 break-even math. But it proves that EOS is no longer a peripheral player. They are sitting at the apex tables of global defense procurement, competing for billion-euro contracts against the biggest primes in the world.
It is the ultimate validation of their technological pivot.
All right. We have dissected the financial contradictions, mapped the technological moats of the laser and the AI targeting systems, and projected the path to profitability. It is time for the final synthesis, the talk ticker's bottom line. When an investor looks at this complex matrix of data, how do they weight the bull case against the bear case?
If you synthesize the totality of the tactical, financial, and strategic information presented in this earnings call, it is intellectually difficult to arrive at any conclusion other than this being a highly asymmetric, deeply bullish signal.
Okay, calling it bullish.
However, it is a bullish reality heavily camouflaged by an ugly, transitional 2025 income statement.
The surface data looks battered, but the underlying machinery is primed for explosive leverage. Let's translate this into actionable strategy based on an investor's current positioning.
We will begin with the current shareholders. If you already hold a position in EOS, the 2025 financial report should be viewed as an incredibly robust safety net.
Your downside risk has been heavily mitigated by management's strategic maneuvers. You have a company sitting on a $107 million fortress balance sheet. They have systematically eliminated all debt, meaning they are completely insulated from rising interest rates or credit crunches.
Exactly.
And they are operating with a locked-in, legally guaranteed backlog of $459 million. The probability of bankruptcy, a sudden liquidity crisis, or a highly dilutive capital raise is virtually non-existent. You are essentially sitting in a secure holding pattern waiting for the transition gap to close and the revenue from the new contracts to start flowing.
The foundational stability is absolute. You are well positioned to ride out the delivery lag. But the calculus changes if you are an outsider looking to initiate a new position today.
If you are considering buying into this story, you need to have a hyper-specific understanding of the exact risk you are underwriting, because you are absolutely not taking on demand risk. The macroeconomic demand for anti-drone lasers and AI targeting systems is effectively infinite in the current geopolitical climate. If EOS builds a 100-kilowatt laser, a sovereign government will buy it immediately.
The risk profile is entirely concentrated on execution. Specifically, you are underwriting their manufacturing supply chain. This is the exact vulnerability that management themselves highlighted during the Q&A portion of the call.
An analyst asked a very pointed mechanical question. They noted that EOS recently expanded their manufacturing footprint by opening a new state-of-the-art facility in Singapore capable of assembling up to 20 high-energy lasers per year. The analyst then asked, if you have the factory capacity to build 20 lasers a year, why is the delivery timeline for the initial Dutch order stretched out over nearly 2 years?
The CEO's response stripped away all the usual corporate deflection. He stated bluntly that the bottleneck is not their internal factory floor space. The bottleneck is the global defense supply chain. He explicitly cited the key components, highly specialized materials they are forced to source from third-party vendors on the open market, have agonizingly long lead times.
I want to break down exactly what those components are, because supply chain is often used as a vague excuse. What actually takes 2 years to procure when building a directed energy weapon?
You are dealing with materials that operate at the absolute limits of physics. You need specialized optical lenses constructed from synthetic sapphire or fused silica, capable of focusing 100 kilowatts of thermal energy without shattering or warping from the heat.
So not just off-the-shelf glass.
Not at all. You need massive power capacitors capable of storing and instantaneously discharging immense electrical loads. And you are reliant on rare earth elements like neodymium, which are used to dope the fiber optic cables that actually generate the laser beam.
And the refinement and manufacturing of those rare earth elements and the polishing of those specialized optics are controlled by a very small, highly constrained group of global suppliers. It is the classic hardware trap.
Exactly.
EOS can have the most advanced AI targeting software in the world, and they can have a massive, pristine factory in Singapore. But if they cannot secure the neodymium-doped fiber cables from their supplier, the laser simply cannot be built, the product cannot be delivered, and the revenue cannot be recognized.
It is an immense execution risk. The defense industrial base has been hollowed out over the last 30 years, and these highly specialized, rigid supply chains are currently stretched to their absolute breaking point globally. An investor buying EOS today is betting that management possesses the logistical prowess to aggressively secure these components faster than their competitors.
So if you buy the stock, track the inventory levels on their balance sheet like a hawk. You want to see them stockpiling raw materials. But even acknowledging that severe supply chain bottleneck, the underlying technological capabilities of this company demand our attention. And to fully grasp their potential, we have to look beyond the terrestrial battlefield. We've spent this entire analysis discussing tanks and drones, but the call briefly touched on an entirely separate, vastly more advanced vertical, the space domain.
The Atlas Space Control product family.
Yes.
This is where the company's capabilities transition from tactical defense to strategic geopolitical dominance.
The Atlas system fundamentally alters how we conceptualize orbital warfare. Management detailed 3 specific operational missions for the Atlas architecture. Mission 1. The system can precisely project a laser from the surface of the Earth through the atmosphere to temporarily blind or permanently desolate the optical sensors on an adversary's low Earth orbit satellite.
You are systematically denying the enemy the ability to conduct orbital reconnaissance. You are blinding their spy satellites, preventing them from mapping your troop movements or your supply lines.
Mission 2. By scaling up the continuous power output of the laser, they can completely disable or structurally defeat the satellite itself. And Mission 3, which is frankly staggering management, stated the laser can physically impart kinetic energy onto space debris or enemy satellites, altering their orbital trajectory and potentially forcing them into a decaying orbit where they re-enter the Earth's atmosphere and incinerate.
Using ground-based photons to force a satellite into atmospheric re-entry. It is a capability so advanced that management confidently stated there's virtually no other commercial entity outside of the heavily classified United States defense ecosystem offering anything comparable.
They are currently marketing stationary, observatory-sized versions of the Atlas system to sovereign governments for roughly $100 million per installation. Furthermore, they are actively engineering mobile variants that can be mounted on heavy transport trucks, allowing a military to deploy anti-satellite lasers dynamically across a theater of operation.
The Atlas program represents an entirely new, incredibly high-margin growth frontier. The remote weapon stations on the Abrams tanks provide a massive, stable revenue baseline. The 100-kilowatt anti-drone lasers provide near-term explosive tactical growth. But space warfare, the ability to control the orbital domain from the ground, is positioned as their ultimate, long-term, next-decade dominant strategy.
Which brings us to the core philosophical shift we must recognize as investors. We began this analysis talking about the visual bias of heavy metal, the tanks, the jets, the explosives, and nothing destroys that bias more thoroughly than EOS spending $36 million of their cash to acquire Mars.
The Mars acquisition is the clearest indicator of where the defense industry is heading.
Here is the final framework for you to analyze. We have spent an hour dissecting the financials of a defense contractor. But when a defense company is deploying tens of millions of dollars to acquire an artificial intelligence software firm, purely so they can utilize advanced neural networks as the targeting brain for their ground-to-space directed energy lasers, the traditional boundary lines have completely vanished. The distinction between an industrial defense contractor that stamps out metal artillery shells and a Silicon Valley big tech company that scales code no longer exists.
It forces the market to confront a massive valuation discrepancy. Historically, technology companies command astronomical valuation multiples, often trading at 20 or 30 times their revenue because software has near infinite scale and virtually zero marginal cost of reproduction.
Right.
Defense companies, conversely, trade at much lower, compressed multiples because bending steel and manufacturing hardware is a slow, capital-intensive, low-margin process.
But the paradigm is fracturing. What happens to those valuation multiples when the core lethality of your military product is no longer the kinetic force of the hardware, but the predictive AI algorithms identifying the target? If the 100 kilowatt laser is simply the physical vessel, the delivery mechanism for the proprietary coterie, how should the market price these assets? Because right now, companies like EOS are not just selling guns, they are selling lethal software.
Investors who stubbornly continue to value these next-generation software-driven defense architectures using the rigid, compressed metrics of the industrial era are going to massively misprice the future of the sector. The economics of warfare have merged with the economics of software.
Lethal software. It is a sobering, terrifying paradigm shift, but it is an undeniably lucrative reality for the companies positioned to write the code. And that brings us directly back to the opening image. The silent, invisible laser systematically burning a drone swarm out of the sky, guided entirely by artificial intelligence. It isn't a blockbuster movie script. It is the reality detailed in a 2025 corporate earnings call, and the contracts are already signed. Track their ability to source those rare earth supply chains, model out that $200 million revenue break-even point in 2026, and manage your risk accordingly. We'll see you on the next deep dive.